Hey guys, welcome back. In today's video, we are talking about AMC taking off, the short margin calls, the biggest problems for hedge funds, and many more in this video. Firstly, we have 6 minutes before the market ended, and you can see the suppression that's happened to AMC today. There was obviously the short trying to push us below $1. We have 5 minutes before the market ends. Comment down below where you guys think it's going to go. But firstly, let's talk about what has actually happened today. Firstly, we've had a big batch of calls being bought. We had the volume going up. Now, we needed the price to obviously hold the breakout, but we knew the short was going to continuously short AMC and put any pressure they can to prevent AMC from going up. You can see at one point AMC was up at 1.012, but the highest we went today was 1.07. And so we were expecting this manipulation. If you see here, today's going to be a rough day because the people who are trying to attempt to suppress AMC share is going to find it more and more difficult. And the reason why we say this is because firstly, the box office has proven to be even better for the industry, meaning AMC is going to do well. But secondly, if you take a look at the dark pool that was being used, and this was throughout the day. So at 10 a.m., we saw 81%. Now this is as of 3:25 because it's not updated yet. We saw 80%. So it was constant 80% dark pool usage throughout the whole day. 4.28% went on the NYSE. So over 22 million shares, this is the data that we're seeing, has actually gone into the dark pool, and only 1.1 million shares has actually had effect on AMC. And this is how we know that we're not seeing the price action right now. This is how we know that AMC closing above $1 is extremely scary for the short sellers. And that's why we saw this today, because why else would suddenly AMC be sold off? If everyone's holding on to AMC for the long term and they want AMC to be in $10, $20, $30, why would they sell the moment AMC go over $1? And the question to that, or rather the answer to that, is because it isn't the investors selling, it's the short sellers trying to push it down even more. And now this is what Peter Han's saying. I'm sure there was a perfectly valid reason why AMC was trading under $1 last week, and because it was swap reset related. Now, what some of you might not realize is when things go over the counter into financial engineering, all kinds of monstrosities can be created. And with better AI and more computing power, the scale is much bigger. And this is something we've always said. We have to remember this right now. This market has gotten bigger every single year. One of the biggest market events we always refer to has been the 08 recession. But you have to understand what they have done throughout the last few years will be huge. The 08 recession will be nothing compared to what will happen when everything they've done recent years will go into collapse. We've seen the amount of swaps, we've seen what they're trying to do to AMC, what they're trying to do to GME, and it's why every time you see even the slightest movement in AMC, you see this desperate attempt to try and push AMC down because they can't afford to have AMC go up to certain levels, because that will bankrupt not just one, but multiple large hedge funds and market makers are out there, and it's going to involve billions and if not trillions of dollars. Another thing we're seeing is that, of course, is this, the margin debt vertical, AMC going vertical. Is it a coincidence or leverage finally getting checked? 500 billion plus in borrowed exposure, and people still acting surprised when candles go straight up. Overextended system plus one-sided positioning equals price stops negotiating. So one of the things we talked about is, of course, firstly, this femoral margin debt, which we've shown in the past before, but also because of the swaps we've just mentioned earlier. And now every time we see when something happens with swaps, whether it's AMC swaps, GME swaps, or any other, essentially anything that has an effect on the stress of liquidity, the stress of margin, we see AMC actually having volatility towards that. And so this is why we've said AMC is tied up to so much of the liquidity, not just with the short sellers who are trying to short AMC, but all of these other funds who are using the collaterals, who have these swap baskets that are tied together. They're all connected back to AMC, back to GME. And so it isn't just going to be the short positions they have on AMC that's going to be affected when it squeezes, but it's why we've always said it will be in the billions, if not trillions, because it contains multiple other different areas that's easily going to have a massive effect. One of the biggest things we've said is, how can a short make money without closing their short positions? How can a short close their position without shares to do so? How can the stock price continuously go down if shorts are closing the position? The fact is they can't close unless we sell. And this is obviously very simple to understand because firstly, it's very simple. We know that the shorts haven't closed their short position. So how are they claiming to make money? And we know that they are not making money. Wherever it's you're looking at hedge funds that are borrowing to pay out their investors, wherever it's you're seeing a hedge fund's debt that is going up, all of these are examples of how they are not actually making money, but borrowing money. Now, another thing we know is that they can't close the position because they don't have the shares to do so. And the biggest way we can get this is because of the FTDs. If they had the shares to close out for the short positions of AMC, of GME, you wouldn't see this constant FTD. You wouldn't see AMC be on the threshold list. You wouldn't be seeing the ETFs that contains AMC and GME to also be on the threshold list. And so it's precisely we've seen the amount of FTDs that exist for AMC. We know that the shorts haven't closed. And one clear thing as well, if the shorts have closed their position, AMC wouldn't be going down. When the shorts have to cover a position, they have to buy a share to sell to cover that position. And typically when that happens, the price of that stock goes up. So you're telling me is that shorts have covered, yet the price continues to go down. And we know that that obviously isn't the case. So this is how we ultimately know that the shorts are still stuck in this. And it's why they're trying to put billions of dollars to suppress AMC. It's why we've seen this 500 billion plus. It's why we see the billions of swaps that exist out there for AMC and for GME. Now, last time AMC was this low, it was in the far worst business position. AMC now pays almost $500 million on debt per year, but that's covered by just one great film in a year, film merchandise on confectionery alone. Debt is reducing, more films being released, and loyal diamond-handed apes. So there's a few things to obviously talk about here. Now, what we have to understand is that AMC, we knew that the only way for it to be bankrupt, the only time it showed bankruptcy potential was because of COVID. Because there was literally no business whatsoever. And so the only time I expected, or at least it made sense for the AMC share price to be low would have been when it had zero business. But now we're at a state where the share price is reflecting as if the company is out of business, but when we are doing better than ever. Of course, the debt issue, we've talked about this as well. We talk about restructuring. We talk about paying off debt. You can see how AMC is improving. You can see how they're paying off debt. And so this is how we know that they are improving. And this is why we always made the comparison. How can AMC be as low as when it had zero business, when all of his theaters was closed down and not producing any revenue whatsoever? It clearly doesn't make sense. A big problem for the hedge funds now is that they realize what's going on. After years of sequels, original movies are suddenly winning at the box office. So now we're seeing more and more movies that are coming out that are doing exceptionally well, and it doesn't have to be a sequel. And I think that is a big part to what's going on right now. And I've talked about this before. Firstly, we have the addition of several upcoming blockbusters like Project Hail Mary that we knew did well, and attendance is expected to increase significantly also for more modest titles as the theatrical window is extended. And so this is what we've said. Firstly, attendance is going to go up because the theatrical window is extended. Secondly, we don't need sequels to actually attract viewers. All of these are massive factors for AMC. If we take a look at the Q1 box office right now, we're at $1.7 billion. So we're only $22 million away from the best Q1 post-COVID. And I want to talk about this, which you're talking about the sequels. If you take a look at a lot of the films that are on here right now, you can see Captain America, Brave New World, Dune Part 2, Avatar The Way of Water. All of these are sequels, and they took up a massive percentage of, you can see 13.8, 15.7, 16.3, even here the Batman with 25.1. And so what we talked about, a big point that we've said was that we saw films like Project Hail Mary, which did extremely well, and the same with Avatar Fire and Ash, but yet it was only 9.6% of the total box office. And this is what we have to understand is very important. We don't need just the one movie to carry us like we did in the past. Not to say that Project Hail Mary did bad, of course it did exceptional, but we don't need a weighted movie like here, 13.8, 15.7, 16.3, especially the 16.3 is very important because that's how it ultimately was able to create the best Q1 post-COVID. But now we're able to do so because we are consistently getting movies that are doing well. And this is extremely beneficial for AMC, for the box office, because we're only going to see more and more of these movies get released as people realize how well this is. Now, we talked about briefly a partnership between AMC and GME. Now, I want to make it clear that obviously nothing has been confirmed. This is just what people hypothesize could be, but more also talking about how useful this can be. Because we talked about the GameStop upside, which is turn AMC locations into hybrid retail hubs, equity staking AMC with asymmetric upside, potential board C. For the AMC, we're seeing increased foot traffic, committed strategic partner, extended the use of theaters, path to reducing debt burden. So there is multiple kind of advantages for the two that's coming in together if they do come together. Like I said, nothing's been confirmed, but this is something that people are talking about, and I'm just showing what could be the good of this. Now, at the start of the video, obviously I asked you guys, where do you think we will end? We were faced with the manipulation. Let's quickly take a look at the price, 0.9851. So this is something that, again, short wants to bring us below $1. The very fact that we were able to actually break above it today and have a massive percentage move like we did to go to 1.07, this is already a big sign as well. Remember, this is only the start of the week. We already have the volume coming in. You can see how shorts are going to get more and more worried. Now, let's go back to the news. Let's take a look at GME as well. So we have to understand that GME is also doing exceptionally well. We see how much free cash flow they have. We see how much cash they have. And of course, almost zero debt. And what we are looking at is how GME can grow. And we talked about this with it going back to AMC as well. And the two combined together. And you can see how easily we can trigger a massive effect in the market. And more importantly, squeeze happens because of accounts like this. 18 million short book, 93% leaning one way, margin maxed out, walking on glass. Now, it's very simple. The reason why AMC is going down, the reason why GME is having still movement is because it's faced with constant pressure every single day that short sellers have sunk in billions and billions and billions of dollars. The one thing about this, what we don't see, but yet we know it's happening, is that every time AMC or GME has slight movement upwards, that's having massive effects to the liquidity stress of these hedge funds. And it's because we know that they're maxed out on shorting AMC, that any movement, any volatility, any price increase will have a massive effect. And that's what they're worried about. And that's why recently we've seen how short sellers and hedge funds are trying to find other alternatives. It's why we've seen this tokenization being allowed. And this is how we ultimately know that we are getting close to our goal. You can see Wall Street is going to unwind. Banks loaned out nearly 500 billion last quarter to keep the market alive. So if you want to talk about the stress that we're bringing these guys, the liquidity that I kept on talking about, this is what we're looking at. Why else would they need to borrow so much more money if they're not stuck with bad positions? And when you take a look at some of the biggest companies that are out there, some of these biggest hedge funds, some of these biggest banks, and the positions that they contain, you will see similarities. You will see short positions of AMC. You will see swaps of AMC. Of course, the same applies for GME as well. And that's when you know we are doing what we have always said, and we are getting closer and closer to the squeeze we have always talked about. Big thing, IWM, we see 3.8 billion worth of fails to deliver. And this is something I said earlier as well. Why would we see constant FTDs on ETFs that contains AMC and GME? It showcases the demand for our shares. It showcases that these short sellers and whatever things they've talked about covering AMC, about not needing AMC, about everyone's ignoring AMC, is clearly not true. Because we've seen this from the FTDs on AMC itself, on GME itself, and we've also seen this with tokens, like we've said in the past. We've seen it with swaps. And now if you want to take a look at something that's not direct AMC, direct GME, but yet it's still related, it's the ETF that contains AMC. It's the ETF that contains GME. Those are sought after by these hedge funds because they want our shares. Now, another big thing about how potentially regulations are trying to protect the hedge funds and the market makers is we're seeing the CAT system or limitations towards the CAT system. Essentially, they want to delete certain CAT data, including all CAT data older than 3 years. They want to ease requirements related to the reprocessing of late records, and then they want to relax certain processing deadlines. So the CAT system that was rolled out as a way to bring transparency to the market, as a way to catch out the bad actors, which we did see it actually work. We saw it catching out the people. There was no consequences for these guys whatsoever, but nevertheless, we saw how it actually exposed so many things that are out there. And now we're seeing the limitations being imposed on this. We're seeing how it's going to have less and less of the power of what it was intended to do. And so it just seems like what we saw, all the exposed data, it was just getting too much for the regulations. They knew that if it gets out of hand, if it blows up, it's easily going to crash the market. So now they're just trying to turn a blind eye to it and just naturally let it occur, as opposed to manually do something because they are afraid of the consequences. This is why hedge fund managers were the least hedged in 8 years going into this market sell-off. So essentially, they have not taken out protection against big stock price drawdowns. Now, as apes, this is what we want to hear. As a normal investor that invests in the overall market, this is not what you want to see because they have not protected their positions whatsoever. If you have your funds invested in a hedge fund or any funds that manage your money, potentially they did not protect themselves. And so this drawdown, they are seeing it at face value. They are not protecting themselves one bit. So if you want to talk about a potential margin call, a potential liquidation for multiple firms, this is the biggest data that you can see. And this is what we could potentially be seeing for the next few months, especially if this whole market, the whole talks with Iran, all of this thing is going to continuously happen. Because if you take a look at, firstly, banks have tripled lending to private equity and credit since 2018. The first big sign, in terms of everything we just talked about as well, about the 500 billion plus, on top of this as well, everything that's ongoing. There's a big reason for why all of this is happening right now and why everyone is talking about this. If we take a look at Brent crude oil, we're seeing how the price surges above $115 per barrel. Obviously another crazy factor, but this is just ongoing. And now we're seeing an energy crisis, and this is having a massive effect already. Nikkei, we're seeing it down 5%. We've already talked about what will happen when the Japan economy crashes. The Japanese yen carry trade. All of these things have been mentioned in the past before. And now everything is just slowly accelerating everything that we have talked about. And now the hedge that people are looking for, what we're seeing is firstly, dollar share of global reserve just fell to 56.8%, lowest since 1994. So this is not the hedge. This is not the safe haven. The dollar doesn't have the value it has in the past before. What we're seeing is people flocking to gold and silver. And that's how we know that at this current market, we're seeing massive and insane things happening. Because we're seeing gold and silver that is going to have a massive increase. And what we are seeing is that it's yet to enter this bullish super cycle. And so if we take a look at how this is going to do for AMC, firstly, we talked about theater industry is a very recession-proof industry. So if we are seeing a recession, AMC will not be heavily affected like all of these other stocks. Secondly, if we're seeing gold and silver go into the super cycle, you're going to be looking at AMC investments to HYMC go up even further. And also the apes who bought HYMC to also see a massive return in their investment as well. So this is how we know we are being the short sellers. As always, none of this is financial advice, so do take advice on salt, make sure you do your own due diligence research, and I'll catch you guys next time.